Hello students, welcome back to Accounting 2401, Principles of Financial Accounting. This is Dr. Mercado speaking. I hope all of you are having a fabulous week thus far. This will be a continuation lecture over Chapter 9 dealing with long-term assets, fixed and intangible. In this particular lecture, I am going to be covering problem 9-2A. So by now, you should have read the chapter and you should be familiar with the different depreciation methods, okay? Now, this particular problem deals with comparing the three depreciation methods. So the information provided is we have Dexter Industries purchased a packaging equipment on January the 8th for $72,000. The equipment was expected to have a useful life of 3 years or 18,000 operating hours and a residual value of $4,500. The equipment was used for 7,600 hours during year 1, 6,000 hours in year 2, and 4,400 hours in year 3. Instructions. We are to determine the amount of depreciation expense for the 3 years ending December 31st by the straight line method, the units of activity method, and the double declining balance method. Also determine the total depreciation expense for the 3 years by each method. The following columnar headings are suggested for recording the depreciation expense amounts, and I've already set up my template the same way. We've got the year, straight line, units of activity, and double declining, and then we have our total at the bottom, okay? So that is the first requirement, which is calculating the depreciation using the three methods. After we do that, requirement 2 asks us which method yields the highest depreciation expense for year 1. And then requirement 3, what method yields the most depreciation over the 3-year life of the equipment. So let's start off by calculating the annual depreciation for the three methods. The first method we have is the straight line method. The straight line method is the simplest form of depreciation. We basically split the depreciation evenly over the life of the asset. So the formula that we use is the cost minus the residual value divided by the useful life, okay? In this particular example, the cost of the asset was $72,000. That asset is going to have a residual value of $4,500. And then I'm going to divide by the useful life, and this equipment is going to last us 3 years, okay? And let's see what we get. So we've got 72,000 minus 4,500, which is my residual value. That gives me 67,500, and then I'm going to divide by 3 years. So my annual depreciation is going to be 22,500. That is your annual depreciation. Every year we're going to depreciate at 22,500. Okay. And then we get a total. Okay. Now that total represents the amount of your it represents your depreciable cost, which is the cost of your asset minus your residual value, okay? So the cost of your asset is 72,000 minus your residual value is 4,500. So 67,500 is your depreciable cost. This is how much you're going to depreciate your asset for, okay? So that is the straight line method, okay? Now, the units of activity method is dependent on the use of the asset. The more you use it, the more the depreciation. The less you use it, the less the depreciation, okay? So, in this particular case, the formula is going to be the cost minus the residual value divided by the units of activity, okay? So, once again, my cost is 72,000. I'm going to subtract my residual value of 4,500, and I'm going to divide by the units of activity. Now, in this case, the problem says that this equipment is going to last us 18,000 operating hours, okay? And let's see what we get. So we've got 72,000 minus the 4,500 residual value. That gives me 67,500, and we're going to divide that by 18,000 hours. So for every hour that we use this equipment, we're going to depreciate it $3.75. Okay. So my depreciation per unit is $3.75. That does not change for all 3 years. Okay. Now what does change is my units of activity. Okay. It says here that year 1, you used it for 7,600 hours. Year 2, you used it for 6,000 hours. Okay. And then year 3, you used it for 4,400 hours. Okay. So I've got my depreciation per unit, and I'm going to multiply by my units of activity. And let's see what that gives us. So we multiply the depreciation per unit times the actual hours used, and that will give us an amount, okay, of 28,500 for year 1. For year 2, it's 22,500. And then for year 3, it's 16,500. Okay, so as you notice, the depreciation varies based on the activity. The more activity, the higher the depreciation. The less activity, the lower the depreciation. Okay, so the trick here is to calculate your depreciation per unit correctly, because that's what's going to be flowing over here to be able to calculate your annual depreciation. Okay. Okay, so I'm going to transfer this over. I'm going to copy it and I'm going to paste it up here. Let me paste it as values. Okay, and then I'm going to add those 3 numbers and let's see what we get. Okay, so we got 67,500 again, and that is correct because that is your cost minus your residual value. Okay, so all we did here was calculate your units of activity. Per unit, in this case, we had the cost of 72,000 minus my residual value of 4,500 divided by the number of hours we expect the machine to last, which we said about 18,000 hours. That gives us our per unit cost of 375. You multiply that by the units of activity, how many units were used up during that particular time, and then that will give you your annual depreciation. And I'm going to go ahead and I'm going to add that here. So that gives me the 67,500. Now, last but not least, we have the double declining balance method. This is a little bit trickier. I added the steps that we need to take into account when we're dealing with the double declining balance method. So step 1 says determine the straight line percentage using the expected useful life. Determine the double declining balance rate by multiplying the straight line rate from step 1 by step 2. And then compute the depreciation expense by multiplying the double declining balance rate from step 2 times the book value of the asset. Okay? So, the first thing we have for year number 1, okay, is we are going to figure out our depreciation rates, okay? So, for year 1, we're going to go ahead and we're going to do that. So it says determine the straight line percentage using the expected useful life. Okay. So using the straight line percentage, we are going to, how can I explain this? So using the straight line percentage, using the expected useful life, we have to calculate the rate. So using the straight line method, we are going to have 1 year over 3, okay? 1 over 3 years, okay? Okay, that is the rate that we're using, 1 over 3. Now you can use, let me change that. You can use actual numbers. I like to use fractions when I'm using calculators, okay? So what we're doing here is, okay, if I were to depreciate my asset using the straight line method, I would depreciate it equally 1 every 3 years. So we're going to depreciate it into 3 parts, basically, okay? So if we were to do that, 1 over 3 gives you 0.3333, okay? So you can either use the fraction 1 over 3 years, or you can use 0.333333, okay? And I'm going to put that here. 1.3, okay, or 0.333333, kind of like that, okay? That would be your rate, okay? Either or. 1/3, 1 over third gives you 0.33333, okay? Now step 2 is you're gonna double, okay? Determine the straight line percentage using the expected useful life, okay? Determine the double declining balance rate by multiplying the straight line rate by 2. And so in step 2, we're going to multiply the 1 over 3 by 2. And let's see what that gives us, okay? So 1 over 3 times 2, that gives me 0.6666667, okay? So your rate is going to be either what's 1 over 3 times 2, it's going to be that, or it'll be 2/3, 2 over 3, you're doubling it, 2 over 3, or 0.6666667, okay? Whatever the calculator is, okay? So we're doubling it. So the original depreciation rate was 1 over 3. I'm doubling that, so it'll be 2 over 3. Okay, so 1 over 3 times 2 will give you 0.6666667. Okay, so you can decide whether to use a fraction or a decimal. To me, it's more accurate to use a fraction because sometimes students, unless you're doing the calculation in the actual calculator like this and you don't delete it, you won't have any issues. Okay. And then compute the depreciation expense by multiplying the double declining balance rate times the book value of the asset. Okay. So the book value of my asset is $72,000. Okay. And I'm going to multiply it by the rate. And you can do either 0.6666667 or 2 over 3. Okay. I'm going to do 2 over 3 just because it's simpler. Okay. For me. Okay, so I'm going to go ahead and I'm going to do the 72,000 times 2 over 3, and that gives me $48,000. Okay, so my depreciation for year number 1 will be $48,000. Okay, now you can do the long way, which is 1 over 3 gives me 0.3333. You have to keep it as is. Once you keep it as is, you multiply by 2. It gives you that long number. Once you have that long number, then you multiply it by 72,000 and it gives you 48,000. The key here is that you have to continue using the number given in the calculator. Don't delete it and you type it out, because if not, you are going to have rounding issues. You have to do it within the actual calculator. So 1 divided by 3 gives you your initial straight line rate. You double that, you multiply by 2, it gives you that long number. Once you have that long number, then you can multiply by the cost, which was $72,000, and it gives you the $48,000. Okay, so for year number 1, the amount is $48,000. Now for year number 2, we're going to start off with the cost, which was $72,000. I'm going to subtract the depreciation from year number 1, which was $48,000. Okay. And then I'm going to multiply by my rate, which is 2 over 3. Okay. And let's see what that gives us. Okay. And I think that goes down here. Okay. And then that is going to be, okay, so it'll be the cost, the initial cost, $72,000, minus my depreciation for year 1, which is $48,000. That gives me $24,000, times my rate, which is 2 over 3. And that gives me a depreciation for year number 2 of $16,000. So your rate is 2 over 3 in this particular example. That's step 2. Okay. So 16,000 for depreciation for year number 2. Okay. Now for year number 3, it gets a little bit tricky. Okay. So we're going to get the 72,000. Okay. That's the original cost. Okay. And then you're going to subtract the depreciation for year number 1. This is year 1. Okay. And you're going to subtract the depreciation for year 2. Okay. And you're going to subtract. Now this is very important. We are going to depreciate all the way up to the residual value. So this is the last year that we are depreciating. I need to make sure that I leave my residual value of $4,500. So I'm going to subtract my residual value. So I'm going to subtract my residual value. Okay, and let's see what that gives us. Okay, so we're going to have the 72,000, the original cost, minus my depreciation for year 1, 48,000, minus my depreciation for year 2, 16,000, minus my residual value of 4,500. That's going to mean that I'm going to depreciate this particular asset for $3,500 on the last and final year. Okay, that would be your final depreciation for year number 3. For year number 2, it was 16,000. For year 3, it's 3,500. Okay. So that is the depreciation using the double declining balance. I'm going to copy that over here, and then that gives us the total. Okay. And you notice all of them should give you the same total because you're depreciating the same asset for the same amount of time. Okay, so that will let you know if your calculations are kind of correct. Okay, so let's go back to that double declining. These are the steps for the double declining balance. First, you get the depreciation rate for the straight line method, which is the number of years over the total number of years. So it's 1 year over 3 years. That's going to give you either 1/3 or 0.333333. Once you get that, you multiply by 2, and that will give you either 2/3 or 0.66666667. Once you have that, you multiply it times your book value, which is in this case 72,000, times 2 over 3. That's the double rate. That gives me 48,000. For you to be able to calculate year 2, you have to get your initial cost minus your depreciation for year 1 times the double rate, which in this case is 2 over 3. And that will give you the amount for your depreciation for year 2. Okay. For year number 3, only if it's the final year. If this is the final year you're depreciating it, you're going to get the cost, which is 72,000, minus the depreciation for year 1, which was 48,000, the depreciation for year 2, which was 16,000, minus the residual value. Okay, and then that will give you the amount that will be depreciated the last and final year of the asset. Okay, so that is how we calculate requirement 1. Okay, what method yields the highest depreciation expense for year 1? Okay, so for year 1, if we notice here, let's compare year 1. Okay, so which one gives you the highest depreciation? The highest depreciation will be using the double declining balance method, $48,000. Okay, so the double declining balance method yields the most depreciation expense in year 1. Okay, so requirement 2. Okay, okay, the double declining balance method yields the most depreciation expense in year 1 of $48,000. Okay, so if we look at the 3, we compare the 3 for year 1. The one that yields the highest depreciation is a double declining balance. So that is requirements 2 answer. Okay, now requirement 3. What method yields the most depreciation over the 3-year life of the equipment? So if you notice, over the 3-year life, all 3 yield the same amount, 67,500. Okay. Okay. So over the 3-year life of the equipment, all 3 depreciation methods yield the same total depreciation of 67,500, which is the cost of the equipment of 72,000 minus the residual value of $4,500. Okay. So all three will yield you the same because we're depreciating the same asset. So if you don't have the same number for the total, then you made a mistake somewhere, okay? So the amount of the annual depreciation will vary depending on the method, but the total will be the same. Okay, it's just how we allocate. Like the double declining accelerates the depreciation at the beginning, the couple of first years, and then it dwindles down. The units of activity varies based on the actual usage of the asset. The more you use it, the more the depreciation. And the straight line method is basically a very simplified method. We depreciate the same amount regardless of production or use every single year. So every single year, you'll just have the straight line depreciation entry be recorded. Okay. So remember, this is a super important problem. You're going to see this on your exam. Please practice on your homework. You do have 2 tries, and I do keep the highest grade earned. So if you didn't do very well or didn't quite understand a topic, please go back and retake your assignment. That way you can have more practice. And if you have any questions or concerns, please do not hesitate to reach out to me. I am here to assist you. Just do make sure you have, or you email me, or you provide me with the problem that you're working on, because every student has different problems, your attempted solution step by step. That way I can review it and provide guidance. Okay, so that is basically it for this lecture. I hope all of you have an amazing rest of your week, and until next time, thank you.